There's a much bigger and more important change that most investors need to know about outside of capital gains. What is that?
I buy property today for $700,000. I sell it in 10 to 15 years. I sell it for 1.4. I've made $700,000 in a gain. But that means nothing if you can't afford to hold that property for that 10 to 15 years.
Capital gains tax is important, but the ability now to either never invest or be able to invest in buying a new property, it's huge.
These changes really are just going to move people in really one direction, which is pretty obvious, which is going to be a little bit's happened in the last few weeks. Big changes to the government's assessing negative gearing or treating negative gearing and capital gains tax.
Easily and by far one of the biggest shake-ups when it comes to property investment market and capital gains tax. Without getting too lost into the detail, historically, we had a 50% concession from capital gains. So if we held the investment property for more than 12 months, if we made $500,000 gain, we would then take 50% off that, the component of which was not subject to tax. That $250 was subject to tax. Now, keep it simple, a husband and a wife buy that property. The 50-50 is the ownership. That $250 will be split two ways, $125 to the wife, $125 to the husband, and they'll pay tax on that amount. So whenever they sell the property, that $125 each sits on top of their working income as if they earned that in that fin year, and then pay the relevant tax bracket. The key difference now is they're moving to the indexation model that existed between, I think it was 85 and 99. Same structure, split two ways against the two owners, and then it gets put on top of their annual income. The capital gains tax is the cost of doing business, whether we had the old model or the new model. It's not like a deal breaker. It's something we need to consider and get the information around, but that's not the real deal breaker. The most important by far is the negative gearing change. So there's a much bigger and more important change that most investors and our clients need to know about outside of capital gains.
Yeah, so it's negative gearing. Like obviously the thing that I think most investors hear when they hear of investing in any sort of property is negative gearing. Negative gearing really is essentially being able to deduct the extra expenses over and above what you're getting in rent, right?
So let's keep it simple. The income of the investment property, whatever that income does not cover, interest on the loan, running costs, land tax, council rates, water rates, maintenance, property management costs, whatever the income does not cover, that out-of-pocket expense, what the income versus expenses does not cover. We used to be able to claim that on any and all properties against our taxable income, receive a tax benefit from that, get a check at tax time, and basically be able to reduce our out-of-pocket expense. So do you want to talk about the key difference post this new budget?
Yeah, really simply, it's just, it used to be that you were able to claim negative gearing benefits, which again is the tax deductions over and above what you're getting as an income, as a loss, and effectively get a tax refund for all your deductions. So let's say, just a simple example, you got a property that's renting for $500 a week. So you're looking at roughly 25 grand a year worth of rental income. So all expenses over and above 25 grand were tax deductible. And so your interest on the loan, depreciation.
And just to give a real life example, if I bought a property, I didn't put cash into it, I used equity, borrowed all the money to hold that property, forget about the income, what would be the cost? Interest rates, all the running costs, what would be on today's interest rate an average sort of cost to hold that property?
That sort of property, you're probably looking at between 50 to 60K in outgoings.
Interest, our running costs, everything? Yep. And then if we're getting $25,000 a year in rent, the shortfall in that example could be $25,000.
Yep. Which
if you break that down on a weekly basis could be, again, it moves with the purchase price and the yield and all the other variables, but circa $500-$600 a week.
Yep.
Right. Now, for most investors, certainly the clients that we deal with, of course, there's exceptions, people with fantastic cash flow, great incomes, but most investors are mum and dad investors on very, very normal incomes. And again, that misconception that we talked about in a previous episode, I have to be on a massive income to invest. You don't. And the stats bear this out. It's people on just average incomes. Now, what that means is very rarely are we meeting with people, and a lot of people fit into this bracket. They are now priced out of the market. They will not be able to afford the out-of-pocket expense to hold those investments.
Yep. And I think that's the thing that a lot of people don't think about is like, it doesn't matter how much theoretical money you're going to make out of that property from capital growth. Yeah. And that certainly is the play, right? I buy property today for $700,000. I sell it in 10 to 15 years for 1.5, double my money. I sell it for 1.4. I've made $700,000 in a gain.
Yep.
But that means nothing if you can't afford to hold that property for that 10 to 15 years, right? So
cash flow keeps you in the market.
100%. So these changes are huge for that because, again, it just means that properties that maybe were with negative gearing in place on an established or older secondhand property, you would get a tax refund, okay? And so that 25 grand loss on paper you effectively get about a third of that back if your tax rate's say your average tax rate's roughly 30%.
Yeah.
You'd be getting a refund of roughly 30% back of your overall excess expenses.
Yeah.
So
essentially bringing that $500-600 down to $300, let's say.
yeah, correct, exactly. You get basically just take whatever the out of pocket cost is and reduce that by a third. So you all of a sudden you're getting an extra $150 to $200 a week in your pocket from tax refunds.
Yep.
Which brings down your out of pocket cost.
Yep. Now you mentioned something that stood out to me. You said for established properties. So part of the new budget that's super important. The government didn't want to hurt supply. We were actually very skeptical that they would do this, because if people are disincentivized to go out there and buy new properties, there's an economic impact, because a lot of our GDP, our economic growth is the construction industry, but more pertinent to housing supply. Properties aren't getting built, less investors are in the market building and developing new residential property. There's less supply coming into the market. There's the same amount of immigration, the demand piece is there, but with less supply, obviously it'll push prices up. So now the key difference for us, and we can talk about in another episode why we've always had a bias towards new property, but the changes, and this is very important, do not apply to new properties.
Yep.
Right. So yes, the capital gains tax, we discussed that before, has an impact and it's relevant. You need to understand it. But the biggest one by far, as we mentioned, is the holding costs.
Yep.
New residential properties are now exempt from any changes.
Yep.
It's business as usual.
Yep.
So for most people going out there to invest, it literally is either don't invest in property or you must buy a new property.
Yeah.
So
well, not only that, it's even better than that example that we went through before with the established example. Right? So an established property is going to cost you, say, $500 a week out of pocket at least to hold.
Yeah. Often much more.
Much more. New property, right? So you get the negative gearing benefit, so that already brings you down $150, $200 a week.
Do we only get that?
Well, that's the thing. On top of your normal deductions, new property already up until recently has been the only asset class you don't get it on established, getting full depreciation. So there's, for most people listening have probably heard about depreciation but aren't really sure what it means or what it does, what it refers to. There's really two parts of your depreciation. You've got the depreciation for the actual structure, which is like the frame, the base, the actual shell of the building.
Yep.
And that you can claim for 40 years.
Yeah.
And then you got the internals.
That's something a lot of people don't know. 40 years.
40 years. That's the average. So basically they just take 100% of the value of the construction, and then they divide it by 2.5% over 40 years, which is works out to be 100. So that's your one part. The other part is then your internal depreciation. So your curtains, carpets, blinds, your stove, range hood, all that has plants and equipment. All of that has in the ATO's eyes a certain lifespan, and you get to depreciate that over typically 5 to maybe up to 10 years, depending on
across the fitting and fixtures.
So that's all extra deductions as well, and so that again, established property, you got a $500 a week out of pocket cost. That goes then down to say $350 before depreciation, and then with further deductions, like we're getting clients down even under $200 a week in terms of out of pocket costs.
Significant difference.
Yeah. So that's huge, makes it the property then affordable to be able to hold. And again, that is the key determining factor. Again, growth on paper means nothing if you can't hold it for that 10, 15 years.
Yeah.
And new property still gets all those benefits. The out-of-pocket cost is substantially lower, much more affordable to hold, means you're going to be able to hold it for that long term. So these changes, I think, although are a big shake-up for the market, really just going to move people in really one direction, which is pretty obvious, which is going to be into the new property space. And there's other reasons why we already, again, we'll talk about it on a separate episode, but high level, new property for us has always been an easier property to rent, for our clients. If a tenant is going to be renting a property and they got the option between a 20, 30, 40-year-old home versus a brand new one, well, they're probably going to lean more towards the newer property with newer appliances. And
the other piece
nicer.
which people don't think about is most tenants are normal human beings, and if you rent a brand new property, you've given 4 to 6 weeks away of the rent as a bond. You're not going to stab holes in the wall. You're going to be slightly more careful. If every smudge and chip is now your fault coming out of your bond, if I rent a rundown property with all those marks and holes already, I can let my boys run wild. So you get better tenants, look after the properties. They'll pay more rent. They'll stay longer as well. So it's a more set and forget, easier investment to hold long term. And for our clients who are working professionals, they don't want a second job, which is keeping up with investment property. They want more of a passive investment strategy. That's why we've always focused on new. But with these changes, it's a massive shake-up. People are going to flood and flock into the new property. Now, importantly, not always does the government put in a economic package that's actually going to make a dent or change things. Even with more people buying new properties, there is zero chance we're going to be able to keep up with the supply to meet the immigration needs, and it's not even going to make a dent. I saw some reports before it might halt in established property markets to 1% of growth. It was something ridiculous. I think it was sub 20,000. So yeah, the big difference, but I think the holding cost, capital gains tax is important, but the ability now to either never invest or be able to invest in buying a new property, it's huge. So I think for our listeners, it's important you get all the information for your scenario, whether you want to buy new or established, we don't care. But for the clients that need that information, people that want to find out how it works for them, it's really important to book a time to sit down with our team and actually map it out for yourself personally.